The global energy market is once again a theater of high-stakes drama, where every move and countermove can send shockwaves through economies and households alike. Oil, often called the lifeblood of modern civilization, is at the center of this unfolding story, its price dictating everything from the cost of transportation to the price of goods on supermarket shelves. In recent weeks, crude oil prices have surged, capturing the attention of investors, governments, and everyday consumers. The market is gripped by mounting uncertainty, as traders try to anticipate the next twist in a rapidly evolving landscape. Brent crude, the international benchmark, has climbed to $70.44 per barrel, a level not seen in months. This sharp increase signals renewed anxiety about the stability of global supply chains and the resilience of energy markets. Meanwhile, West Texas Intermediate, or WTI, sits at $68.50, reflecting similar upward momentum in the U.S. market. Both benchmarks have experienced significant rallies, fueled by a complex web of factors. These sharp rallies in oil prices are not just numbers on a screen. They represent the heartbeat of the global economy, influencing inflation rates, government policies, and even the pace of economic recovery in many countries. The current volatility is being driven by a volatile mix of geopolitical tensions, strategic supply decisions by major oil-producing nations, and persistent anxieties about future demand. Each of these elements adds a new layer of complexity to an already unpredictable market. The market remains on edge, caught between the threat of looming sanctions on Russia, which could further restrict global supply, and Saudi-led efforts to boost production, as the kingdom and its allies attempt to stabilize prices and reassure nervous markets. OPEC's recent meetings have been closely watched, with every statement and production target dissected for clues about the future direction of oil prices. Recent de-escalation in the Middle East briefly calmed prices, offering a momentary sense of relief to global markets. But that calm was short-lived. As attention shifts back to the fundamentals of supply and demand, volatility has returned with renewed force, keeping traders and analysts on high alert. Every headline, every diplomatic move, and every policy announcement is now scrutinized in real time, as oil prices have become a barometer for global risk and economic sentiment. The story of oil today is one of geopolitical chess and economic uncertainty, with traders bracing for more turbulence and policymakers searching for ways to restore stability. In the next chapter, we'll break down the powerful forces driving this perfect storm of price instability and explore what might lie ahead for the world's most vital commodity. The biggest force pushing oil prices higher right now is the mounting anxiety over the possibility of new, tougher sanctions being imposed on Russia. This uncertainty is sending shockwaves through the global energy markets, as investors and traders brace for potential disruptions that could ripple across the world. As one of the world's top oil producers, Russia plays a critical role in the global energy supply chain. Any disruption to Russian oil exports, whether from sanctions or retaliatory moves, has immediate and far-reaching consequences. Even the mere threat of reduced Russian output can send prices soaring as countries scramble to secure alternative sources and shore up their reserves. In the United States, lawmakers are actively drafting new legislation aimed at ramping up economic pressure on Moscow. This signals a significant shift toward more aggressive sanctions, with bipartisan support growing in Congress. The goal is to further restrict Russia's ability to fund its war efforts, but the move also risks unintended consequences for global markets. Meanwhile, the European Union is on the verge of finalizing its 18th sanctions package against Russia. This new round is expected to include a lower price cap on Russian oil, a move designed to squeeze Moscow's revenues even further. However, such measures also raise the risk of Russian retaliation, which could take the form of production cuts or export bans. Markets are increasingly fearful of a tit-for-tat escalation. If sanctions become too severe, Russia could respond by slashing its oil production or halting exports to certain countries altogether. This would tighten global supply, drive prices even higher, and potentially trigger a new wave of inflation around the world. Traders are not just reacting to the sanctions themselves, but to the unpredictable chain of consequences they could set off. Every new headline or policy announcement adds to the volatility, making it harder for markets to find stable ground. The threat of a global supply crisis is now priced into every barrel of oil, as the world waits to see how Russia and the West will navigate this high-stakes standoff. President Trump's direct involvement has added a new layer of volatility to the oil market. His public disappointment with Putin and promises of advanced military aid to Ukraine signal a shift to a more confrontational U.S. policy. This hawkish turn suggests tougher sanctions are likely, prolonging the conflict and keeping geopolitical risk high. Trump's announcement of a forthcoming major statement on Russia has left markets guessing, fueling uncertainty and risk premiums. Traders are hedging against worst-case scenarios, including sweeping sanctions on Russia's energy sector. The alignment between the White House and Congress makes tougher sanctions seem inevitable. Until Trump's policy is clear, the market will remain on edge. The European Union's 18th sanctions package marks a pivotal moment in the ongoing economic standoff with Russia, aiming to reshape the global oil market in ways that could have far-reaching consequences for both energy producers and consumers worldwide. At the heart of this package is a renewed focus on tightening the Russian oil price cap, a policy designed to limit the Kremlin's ability to fund its war effort while maintaining a steady flow of oil to the world. The challenge facing EU policymakers is a delicate one. Lower the cap enough to significantly reduce Russian revenues, but not so drastically that Moscow decides to halt exports altogether, which could trigger a dramatic spike in global oil prices and disrupt economies far beyond Europe's borders. In response to previous sanctions, Russia has adapted quickly, deploying a so-called shadow fleet of tankers and relying on non-Western insurance and shipping services to move its oil outside the reach of Western restrictions. These tactics have allowed Russian oil to continue flowing, often at prices above the official cap, particularly to buyers in Asia such as China and India, who have become increasingly important partners for Moscow. For the EU, simply lowering the cap is not enough. Effective enforcement is crucial. Without it, the measure risks becoming little more than a symbolic gesture, easily circumvented by creative trading and shipping practices. Yet, a drastic cut to the cap could provoke a strong response from Russia, including the threat of retaliatory export cuts or other countermeasures. If Russia were to remove significant barrels from the market, the resulting supply shock could send oil prices soaring, impacting everything from fuel costs to inflation rates around the globe. As a result, financial markets and energy analysts are watching the EU's negotiations with intense interest, aware that any decision could have immediate and profound effects on global supply chains and price stability. The outcome of these talks will directly influence not only the price of oil, but also the broader economic outlook for countries dependent on energy imports. The EU's balancing act between punishing Russia and protecting its own economic interests has become a key source of anxiety for businesses, governments, and consumers alike. In this high-stakes environment, every decision made in Brussels now reverberates across continents, shaping the future of the global energy landscape and the world economy. As sanctions fears push prices up, OPEC+, led by Saudi Arabia, is working to pull them down by boosting production. Riyadh's steady output increases are a clear signal. OPEC+ will act to prevent runaway prices and fill any supply gaps. This marks a shift from recent production cuts, as the group responds to new geopolitical risks. In June, OPEC raised output by over 400,000 barrels per day, providing a crucial buffer against supply shocks. OPEC+ leaders have hinted at further hikes if needed, reassuring markets that spare capacity is available. This supply-side response is a powerful check on price spikes, keeping panic at bay. The market is now caught between the opposing forces of Russian risk and OPEC+ supply. The push to boost oil supply isn't limited to OPEC+. Guyana's rapid rise, with production nearing 670,000 barrels per day, is reshaping the global landscape. Kazakhstan is also ramping up output, adding another layer of supply security. U.S. shale remains a powerhouse, with current prices incentivizing steady drilling and high production. These new barrels from outside OPEC and Russia create a more resilient, competitive market. The combined output from Guyana, Kazakhstan, and the U.S. helps absorb demand and cushion against disruptions. This global supply surge is a key reason oil prices haven't reached crisis levels despite geopolitical turmoil. The world's oil portfolio is more diverse and more robust than ever. On the demand side, all eyes are on China, the world's largest oil importer. Any slowdown in China's economy or trade tensions with the U.S. could sharply reduce global oil demand. Markets are anxiously awaiting China's latest trade data for clues about future consumption. Ongoing trade disputes and tariff threats add another layer of uncertainty, dampening investment and economic growth. This economic anxiety acts as a brake on oil prices, countering supply-side fears. Traders are torn between the risk of a Russian supply shock and the threat of a demand slump from Asia. The market's indecision reflects this tug-of-war, with prices swinging on every new data point. Until China's outlook and global trade policy are clearer, volatility will persist. U.S. oil demand is surging, with gasoline consumption at its highest since 2021 and inventories falling sharply. This strong summer demand supports current prices, painting a picture of a nation on the move. But warning signs are flashing, consumer confidence is dropping, and recession fears are rising. The market faces a dilemma. Should it trust today's robust demand or brace for a downturn? A recession would slash fuel use, acting as a powerful drag on prices. Higher oil prices themselves could worsen the economic outlook, creating a feedback loop of slowing growth and falling demand. The U.S. is a microcosm of the global dilemma: strong demand now, but storm clouds ahead. This contradiction adds to the market's volatility and uncertainty. July 2025 finds the oil market at a crossroads, buffeted by sanctions threats, supply surges, and economic uncertainty. Tougher U.S. and EU sanctions on Russia could tighten supply and push prices higher, especially with President Trump's hawkish stance. But OPEC Plus and non-OPEC producers are ramping up output, providing a crucial safety valve. Demand-side worries, especially about China and the U.S. economy, are keeping prices in check. The market is stuck between bullish supply fears and bearish demand risks, with every new headline moving prices. Key signposts ahead: Trump's Russia policy, the EU's sanctions package, and China's trade data. For now, volatility is the only certainty. The world's most critical commodity will remain a battleground of competing forces.